All right, and Jamie, welcome to the Face Show. Dale's not here, but you got me, and I can't go on camera because my hair looks like I look like one of those troll dolls that you put on the end of your pencil. That's how I look this morning. So, how you doing, sir?
I'm very well, thank you. How are you?
I'm doing good. Dale's running with a power issue. He lives in California, so sometimes I think his grid gets a little overheated there, and so I think it's being affected this morning. But I didn't want to take away from having you here because, first of all, I've never had an opportunity to meet with you, but I've been reading your work for so many years on Reuters. Tell us what you're thinking right now as far as the heartbeat of where global central banks are at. Are we at a high, first of all, for rates globally, but secondly, are you a believer, and I'm asking you personally, are you a believer that central banks are here to pivot soon?
Well,
I mean, okay.
I think that's the question du jour. And first of all, get my disclaimer in, as a reporter for Reuters. I obviously don't have an opinion, don't have a personal opinion. That's the official line anyway. But yes, I think it's safe to say that peak rates, if you like, is well within sight. I mean, I know we've been saying that for maybe 6 months, possibly longer. Certainly, if you look at market pricing, Fed futures, Fed funds futures, and SOFR markets, they've been pricing in a pivot or a pause or a combination of the two for, I think, about 1.5 years now. And it's no different now. Looking at the 2024 strip, we're looking at 100 to 125 basis points of cuts priced into the curve. Don't fight the Fed is the old mantra. The market's been doing that for, as I say, well over 1 year now. And guess what? The Fed has held the line pretty well. I think it's safe to say we've had more rate hikes than most people anticipated, and certainly more than the market anticipated. And we are where we are. But after 500 plus basis points of hikes in about 18 months, you would have to think, I mean, it's stating the obvious, we're closer to the end of the cycle than the start. But the commentary from the Fed is still, holding the line. The Fed policy seems to be just keeping the market at arm's length, hanging the possibility of one, possibly two more hikes over the market, just so that financial conditions don't don't loosen too much. Because I think if once we get the sort of green light that the Fed's done, you can see a scenario where financial conditions loosen quite a bit, because we will be at peak rates. And then the next step after that is obviously how long does the Fed stay on hold, and then when does the easing start? What's my personal opinion? I think we're getting close. I think the signaling from the Fed is that they are close. However, they just want to keep maybe on hold for the rest of the year and 2024. Although Powell did say, I think, did he not say last week that he doesn't see rate cuts really until
I thought that was probably the most interesting thing of the Fed, the meeting, because the market's been pricing in rate cuts at some point, going into 2024. And when he specifically says, look, we don't see, and then he said, we don't see a recession. I mean, that really, when he says a recession, that means if I'm the market, I got to cue off that and say, wait a second, that means there's no cuts coming.
The soft landing stuff has been quite fascinating. I mean, I think I would have to hold my hands up in a mea culpa. I mean, I was skeptical of the soft landing scenario. Perhaps it won't turn out that way, and these things have a habit of creeping up behind us and biting us where it hurts. But so far, the signs are remarkably that there is no recession on the horizon. Just look at the GDP numbers. Look at the Atlanta Fed forecasts. They're pretty punchy, and some of the indicators, I mean, we've been speaking about them for months now, months and months. The yield curve, consumer confidence, all the bank lending, etc., all the traditional indicators, red flags of recession warning, which we've come to know and trust over the last 30, 40, 50 years, especially the yield curves. They just, so far at least, they're not playing out as we've been led to believe they would play out. That's not to say that the long and variable lags, don't come up and turn out to be just exactly that, lags. And I think that's an interesting point. I mean, we've got Fed Governor Chris Waller. He's of the opinion that the lags now are much shorter. So you're looking at maybe 9 to 12 months for policy to come through and affect the real economy. If that's the case, much of the tightening that's been done by the Fed has already been felt or has filtered through to the economy. If that's the case, we have maybe 150, 200 basis points worth of tightening still to come, but we've already had about 350 basis points of tightening that's already played out in the real economy. If that's the case, the economy's held up pretty well and there are no recession signs. However, if you think the long and variable lags are a bit longer, 12 months to 24 months, I think Milton Friedman's was about 18 months.
Yeah.
Then we've got more pain to come, and so recession could happen. But so far the signs are there's no recession, and if that's the case, the Fed must be pretty comfortable. And I wrote a piece a few weeks ago saying that if, and it's again a big if, big caveat, if there's no recession, if there's a soft landing and no recession, and there's only been one of those in the last 50, 60 years, according to Alan Blinder, one pure soft landing where there's been a Fed tightening cycle and no recession. That was in the mid-90s. If we have another one, could Jay Powell go down as probably the most successful Fed's chair of all time?
I think that's what he's going for, right?
Well, I mean, you have to take your hat off. If, again, it's all caveats and hypotheticals at this stage. If we get through this with no recession, it's pretty remarkable. And I think that would speak to the sort of post-COVID economy, if you like, not just here in the States, but worldwide. I think all the models and sort of things we've been led to believe and expect and trust over the decades, all of that is now thrown into question.
Jamie, I'm going to ask you a question. How long have you been reporting for Reuters now?
With Reuters, nearly 20 years, and I was with Dow Jones for 6 years before that. So about 25 years all in. So
you and I, and I've been trading for 25 years roughly. So you and I are right in the same boat pretty much. So you've seen it all. Well, not all. I mean, we weren't around when inflation was raging back in the, even though we were probably, both of us were kids, we weren't around when like trade or looking. I could care less about what was happening at the markets when I was 10 years old. And probably either. But or maybe you did. I don't, not me. But if you go think about like what's happened, it's been such a remarkable quarter century, I would say. Especially you've seen, the monetary policy that has really gone through the markets over the last 13 years, roughly, since the financial crisis. I take a step back and look at like, I think I have a chart here. Let me see if I can pull it up. Oh yeah, here's the Fed's balance sheet. Just, since 2003. You can see that the response function of the Fed post-COVID is triple that of what happened during the GFC or the Great Financial Crisis. So, with that information in mind, you have to take a step back and go. And I agree with you. If the Fed chairman manages to pull off a no landing, or we have to give a hat tip to him. However, the reaction function of this right here that lag theoretically could end up being 2 years or more. So I think you run into the issue where if you're George Bush Jr. and you put a mission accomplished signage on a battleship, that might be the same situation that we find ourselves in if the Fed, claims they've won a little too early. And I think that's going to be the real interesting thing over the next 12 months, I think, in 2024. Wouldn't you agree?
I would go along with that, certainly. And I think the last people on Earth who will be putting out the mission accomplished banners will probably be the Feds and the FOMC members themselves. They will not want to be too hubristic or presumptuous at all.
Right.
But however, that chart is a fascinating chart. I would just say a couple of things to that. Of course, that's in pure dollar terms, but I think you have to look at that chart as a share of GDP. And of course, it's a larger share of GDP now than it was back in the early 2000s, pre-GFC. However, it's not. It's a far less alarming chart, and I don't have it in front of me. But if you look at that as a share of GDP, it's far less alarming and much more manageable, if you like. And certainly relative to history, it's nowhere near as stark as that. And it's also it's again relative to other G7 central banks and countries. It's not quite it's nowhere near as alarming either.
There's definitely other central banks that have done more. So
much more. Of course, we're here in the States, we're talking about the Fed, and the Fed's the biggest and most important central bank in the world. But the ECB, for example, has done more as a share of GDP. And you don't have to talk about, not to mention the BOJ, although I'm sure we will. The BOJ has been doing this for, well, we're talking 25 years in the business, probably as long as that, if not longer. The BOJ has been expanding its balance sheet. And I think, I don't know where it's at right now, but is it over 200% of GDP, over 250%?
Something crazy like that. And yeah, Japan is its own crazy animal, isn't it? I mean,
it is indeed. And you're talking about when we started in this business. I started in 1998, and my very first week on the job was LTCM.
Oh my God, get out of here. Really?
So that was a baptism of fire.
Oh my God!
I was absolutely. I didn't have a clue what was going on, and some might say I've not learned much since then. But yeah, I mean, and going back to talking about central banks, the Bank of Japan, obviously back then was heavily involved in the market, intervening in FX, and not much has changed over the years. The Bank of Japan is probably the most market savvy or market active central bank. Or major central bank in the world, and the BOJ balance sheet is absolutely ginormous, and yet they've been battling deflation, as we know. Of course, that's starting to turn. Okay, they've not had much growth, or they've had slower growth over the decades. But to the question of the Fed balance sheet, can it stay at high levels and as a big share of GDP? Yes, it can, unquestionably. Obviously, the Fed has the US dollar, the world's reserve currency. Everybody wants to be in US markets. So there's no issue for me in terms of, or there's no real issue in terms of the Fed balance sheet, either nominally or as a share of GDP, which sort of touches on the Fitch stuff this week, the downgrade. Maybe that's a bit questionable, certainly in terms of timing, but the US ability to cover its debts, to pay its bills and to pay its way or to attract inflows or capital, for me, that's not in question, although the level and price at which all that happens can be debated. But the Fed balance sheet, yes, it's an issue, but I would say the BOJ balance sheet has been an issue for 30 years or 20 years and counting. And,
they also have a structural, demographic issue too.
Of course.
I mean, there's so that Japan is definitely a different market, but
go ahead. Go ahead. No, and as you say, demographics and the share of domestic investment or domestic holdings of the bond market, etc. Is very different.
Very different. I wish we were more like Japan in a lot of ways here in the US, but we're not. So, but there's a lot of ways we're not similar, which is also a good thing. But hey, I want to ask you this. Since we're talking a little bit about different central banks and looking at what the BOJ has done, are you following what the BOJ and UEDA is doing over there?
Yeah, I just did a piece, I think it went out yesterday, in fact, on the latest policy move from the Bank of Japan. I'd love to
get your thoughts.
I don't follow it as closely as I did when I was covering FX back in we're talking about early 2000s, mid 2000s, when the Bank of Japan was very active in the FX market, intervening to sell the yen. Of course.
Did you write a lot about Mrs. Watanabe as well? The carry trading ladies?
More than I care to remember. But it's actually it's a fair point, and it's a bit of a cliche, but it's a fair point. I mean, Japan is the world's largest creditor.
Yeah,
they have Japanese investment base, including institutional and retail, has some $4+ trillion worth of bond or debt holdings overseas. Nearly $2.5 trillion of that is in portfolio instruments. So there's a huge amount of money, Japanese money, abroad, much of it in the US, much of it in US bonds and on Wall Street, that potentially could go back to Japan if interest rates become attractive and if bond yields become attractive enough once hedging costs have been taken into account. Right. And the BOJ move last week is, I think, is very important, just as the one was at the end of last year. They're obviously wanting to normalize policy. They want to raise the level at which yields can go. It won't happen overnight. It'll be a sort of longish process, and there'll be bumps along the way. But I think it was a big move. And once, if the Bank of Japan is convinced that the battle against deflation, the generational battle against deflation, has been won, we're talking about mission accomplished banners. But if the Bank of Japan can safely believe that it's won the battle against deflation, it will allow yields and rates to rise. Yields first, then rates. Don't forget, Japan still has negative interest rates. But I think the Bank of Japan's move was well timed. We're talking earlier about peak rates globally. If peak rates have peaked globally, and we're starting to come over the hill now, and central banks, the Fed, ECB, and BOE are looking at next year cutting rates, I think that's a good environment for Japanese money to come home. Global rates start to come down, Japanese rates start to rise, and there'll be a lot of demand for fixed income assets globally. I think the Bank of Japan's timed this pretty well, and also this symbolism of it all. Japanese inflation, if you can believe it, is higher than US inflation on a headline CPI basis.
That is the craziest thing, right?
And it's the first time, I think, in 8 or 9 years that's happened, but it doesn't happen very often, but it's happening now. And, if you think US inflation is starting to ebb, I know the last mile is the hardest mile and all that, but we could have a 2-handle on US inflation pretty soon. And so, I think the Bank of Japan has played this one pretty well so far. And I think the market reaction shows that. Volatility, FX volatility, bond market volatility fell after Friday's move. Okay, Japanese stocks have taken a bath a bit, but I think that's, don't forget, last month, 2 weeks ago, they were at the highest in 33 years. So they were bound to come down at some point.
Right. It's amazing. This could be like, and this is why I think FX traders right now are currently focused so much on the BOJ, is because this could end up being the biggest trade of 2024, 2025 is a big, convergence trade as the BOJ normalizes policy and tries to catch up. And then you almost get a divergent trade if people really believe rates have peaked and they're going to come down, which leads me to my next question. But I really want to ask 2 more questions from you, Jamie. I appreciate your time. But first question really quick. When you are thinking, peak rates, do you think, based on what the information that you have and who you've talked to, do you think the Fed or any other central bank, for that matter, is really going to be cutting rates anytime in the near future? I mean, they're going to need some probing and prodding. As you just said, it's going to be a little too early to claim victory, but what would trigger a response from a central bank to say, hey, we got to cut here?
I think I can't remember the exact numbers, but again, going back over the last 20, 30 years, the average time between the Fed's rates reaching a peak and the first cut, it's shorter than you think. It's a very, very short time on average. Obviously, sometime I think in the mid 2000s was it where I think Greenspan held rates on hold for about a year plus 18 months. but on average, it's actually very, very short. It's a matter of months. So if the Fed has one more hike left in it, I think it's September, is it? End of September, the Fed hikes once more as market is pricing. It's not unreasonable to think that the Fed could be cutting rates in early Q1, Q2 next year.
Yeah.
Even though Powell himself has said he's kind of pushed back against that, and I think I think the Fed rhetoric will be pushing back against that, because, as I said earlier, once the market has that bit between its teeth, financial conditions will go the way that the Fed doesn't really want them to go.
Right. And it's interesting, because I think the way that that people view this, and the market should view it based on history, is, well, the Fed's going to raise rates and they're going to keep them high until they break something. When they break something, they're going to have to lower rates. But we are in a different environment than we were, 10 years ago, 15, 20 years ago. And this isn't your dad's or your mom's Fed or your grandparents' Fed. This is a different Fed. And we're in a different environment, right?
Very different environment. And that's why I said earlier, I think all the rule books, models, and what we thought to be true in economics and markets and reaction functions and central banking has been, I think all that's been thrown up in the air, first of all by the GFC, but certainly by the COVID pandemic. This inflation burst and supply chains, it's the stimulus that the Fed and others put into people's pockets, household savings, how all that interacts.
Yeah.
Really, I think I wouldn't be going out on a limb to say that nobody really has a clue. And I think,
I think you're not going out on a clue.
And I would include policymakers in that. And I know maybe some of your participants and viewers might think, well, plus ça change and all that. But I think, nobody really knows how this plays out. And I think that's been evident by the way the market's been priced. If you said, I think, at the start of the year, if you said in January 1 that everybody thought this was going to be the year of the bond, equities were going to take a bath, and the dollar was, going to go down, which it has a little, of course, all that's been turned in its head. Bonds are flat, stocks are soaring. We've had all this tightening. Tech is up 30%. Big tech's up 75%. None of this was in anybody's forecast. None of it.
Yeah.
So I think that goes to show that we are kind of flying blind, flying by the seat of our pants. And as I say, that includes the Fed. So it's very, as Powell said last week, they're very much data dependent, and going from one policy meeting to the next. I think that's the way we have to play it. And so pricing up 125 basis points of cuts next year, okay. Previous cycles in history would suggest that's not an unreasonable bet, but the last 2 or 3 years would tell you that it doesn't pay to look too far ahead. I think we can be blindsided. Right.
Throw out your models. They may not work. Hey, Jamie, I want to thank you for your time. One last real quick question. Fitch, do you have any opinions there? What do you think about the ratings change with the US?
It's a weird one, isn't it? Again, we're talking about the Bank of Japan, etc., and balance sheets, and I think the timing is to be questioned. If this had happened before the debt ceiling deal was done, and when that was bubbling up into something of a frenzy, and people were talking about default and all that, if this had happened then, you wouldn't question it.
Yeah.
But I'm not quite sure. I'm still not quite sure why they chose to do it when they did.
Well, I forgot there's a Hunter Biden probe right now, and Trump indictment. I forgot about all that because I'm thinking about Fitch. So maybe it's just a little bit of diversion, right?
Diversionary tactics. Nobody's ever used them before. But
never.
But just on a semi-serious note, I think if I remember correctly, the debt ceiling deal pushed out. It's suspended it, did it not, until January 2025? Is that right, or March 2025, which is after the election? And if my maths is right, it's about 18 months from now. So we're in we're on terra firma, we're on safe ground from now until early 2025 as regarding the US government's ability to pay its bills and to borrow, etc. I'm not quite sure why they did this. Yes, borrowing's rising, debt's rising, and the amount of auctions is going to rise, and we've seen the curve steepen. The long end doesn't like it, but I mean, don't forget, we've got the most inverted yield curve on any measure for about 40 years. So I mean, don't people want the curve? Don't people want the curve to steepen? Isn't that part of the game plan?
Yeah, I mean, yeah, we don't want it to continue to invert, right? So
again, I mean, that's but even if it did invert, what signal would that be giving us? I mean, what can we take from that? I mean, if it's 100 basis points inverted, or 120 or 130, we're in territory that we've not been in for 40 years or for decades ever. And yet, markets seem to be bundling along okay. Demand for treasuries is still pretty strong. And just talking of Fitch and the downgrade, we've seen Warren Buffett come out, I think today or yesterday, saying his firm's buying billions and billions of treasuries. Doesn't see a problem with it. And obviously one of the weird ironies of any US debt scare is that people pile into treasuries, and that's happened in the past. I don't think that would be any different. And when you're getting 5.5% for 3 or 6 months borrowing from the US government, why wouldn't you take that?
Yeah, I mean,
that's the thing.
It's this
for 10 years.
Total safe haven play at this point. It's like, okay, well, where else am I going to park my money? And do I really want to be buying risk assets up here? It's a crazy world we live in, Jamie. And I want to say, it's been a wonderful, just having a conversation with you. I really respect what you do with Reuters and you as a journalist. What's the best way for people to follow your work?
I'm on Twitter, or I think they call it, was it X now? Or
X, whatever it is.
At Reuters Jamie on Twitter, and I obviously I'm a columnist for Reuters, so all my stuff appears on the Reuters newswire, and most of it goes on to Reuters.com and is picked up by other media around the world. So yeah, at Reuters Jamie on X or Twitter, and the Reuters website.
So when's Elon Musk going to get when's he going to find himself in some legal battles regarding X? It's got to be coming soon, right?
I don't know. I think I wouldn't say I was one of the early adopters of Twitter, but I joined in about, 2011 or something. I think that was
2011. It's quite some time.
Yeah, it's and it was the place to be for financial commentators or analysts, or the FinTwits and all that.
Yep.
Certainly, I think it's safe to say, again, not going out on a limb, it's not quite as rewarding or as good a place to be now for the financial community as it was back then, or even any time in the last 10 years. It's lost its luster, I think. And,
it has, but I've been here since I think 2009. Let me see if I can go. Yeah, 2009 I think is where make sure I'm correct. Yeah, 2009. I'm looking at it. And I'm
early adopter.
What's that?
Early adopter.
Fairly, but I agree with you. It's not like our it's not what it used to be. But if you look around, it's hard to find something to compete, regardless whether it's X or Twitter. So, but Jamie, I want to say it's been a pleasure. I'd love to be able to chat with you again, and I want to thank you for spending your time with us. I know it's very valuable to you, so thank you for spending it with the ForexAnalytix community. I appreciate it.
Thank you very much for having me. All the best. Have a good day.
All right, all the best to you, Jamie. Take care.
Speak soon.
All right, guys and gals. I'm going to be wrapping it up here for Dale. Dale had reached out to his provider, and he has an outage in his area. So Jamie, he'll be reaching out to you again. So
look forward to it. All the best.
Right. Thank you, guys. All right. Have a great day, everybody. Good luck. And we'll see you tomorrow for Non-Farm Payroll Live. Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.